joining me for a look at the equity scene is Richard Court from Argon Asset Management. Richard, thanks so much for your time this afternoon. So the trade truce still alive, negotiations ending with both parties agreeing to hold off on export curbs. This, of course, is dependent on the green light from Presidents Trump and Xi Jinping. Should we celebrate, or is it too soon?
Firstly, good afternoon. Thank you for having me on your show. Yeah, so the headlines do seem a bit more positive. I think hopefully there is a resolution to this trade impasse between the US and China. I think any lower barriers or preferably no barriers to trade is good for global growth and the ability for economies to play to their strengths. But just in terms of the markets and investing, I think one must always just be just a little cautious in terms of basing decisions on headlines. The market does like stability and it likes certainty, but whether there is a resolution to these trade wars or not, the future remains just as uncertain or as unpredictable. It's just not something that is forecastable. So it's not. So yes. So hopefully there's a resolution and that there's a nice outcome from this, but it doesn't change the challenge when it comes to investing. The how we see the future in the present doesn't change that the likelihood of something coming from left field and the future being unpredictable. So it's just always have to bear that in mind.
And I was about to ask you about the market's performance and how we've been seeing equities fare since we've heard of, the renewed trade truce. It does seem like there is some sort of positivity, but trade still quite choppy. And you've explained that uncertainty still remains. Are markets also now turning their focus to the inflation numbers coming out of the US later today? I was reading a few articles, and many economists are expecting to see prices coming in higher on the back of the impact of those tariffs. Is that also what's capping some of the gains?
Possibly. I mean, I think so the US inflation has been ticking down a bit over the last little while in spite of all these trade fears. But again, it's that what they say about predictions, it just tells you about the person making the prediction. It doesn't actually give you any insight as to what's going to happen. So I could sit here and tell you what I think is going to happen, but that's just giving you some insight into how my mind works. It doesn't give you any insight into what will actually come to pass. Look, I mean, markets like certainty, even though they like the perception of certainty. But we are still in very uncertain times. How we are trying to navigate our way through this is just to stick to our knitting. We are focusing on identifying businesses that have got capable management teams that are able to have some sort of pricing power in terms of the services and products they sell, and have strong balance sheets and are fairly lowly rated. And I think if we continue to put together a portfolio of those sorts of investment ideas, then in the longer term, not every day, but in the longer term, we should do well.
And talking about, those businesses that are operating in these uncertain times, we have Zara owner Inditex posting weaker than expected quarterly sales. They're also warning of slowing sales growth as it assesses the potential impact tariffs could have on consumer spending. This, of course, comes as the US is Inditex's second largest market after Spain. This coming as no surprise, right, Richard? With many companies already accounting for those potential impacts.
Yeah, it's a nice example because, as you said, the sales number for the first quarter missed the sell side's expectations. So I think the share price was down about 3.5% at one point this morning. And and the reason given is because of the uncertainty around the trade war and where the tariffs are going to land and what have you. But what I like about Inditex is the fact that you've got it's still controlled by the founding family, the Ortegas. It has got a very strong balance sheet. I think it's in a net cash position. That means there's more cash than debt. I mean, there doesn't seem to be any financial debt on the balance sheet. I think it's a net cash position of just over 10 billion euros. So you've got this combination of a good business, a very strong balance sheet. It seems to be responsible stewards of that business. So if I were to bet, I don't know what's going to happen in the future. I don't know where the trade hikes are going to or the trade war is going to land. But Inditex seems to be a business that's got a good chance of weathering and thriving in whatever future comes to pass. So it's there. So that's a nice example of it in terms of how we think about identifying businesses in this uncertain environment where you don't know what's going to happen in terms of tariffs.
You know, another company that, seems to be thriving under these circumstances and benefiting from gold being a safe haven is Pan-African Resources. Yeah. Richard, they're out with an operational update while they've managed to produce more gold in the second half of their financial year. They are warning that they might not hit their full year production guidance. Talk to me about what you made of that update.
Yeah, look, a company that's really benefited from the appreciation of the Rand gold price. I think I think the Rand gold price has almost doubled over the course of the year. That covers all manner of sins. I mean, when the price of the commodity that you are selling appreciates so much, it makes up for all sorts of other deficiencies. Having said that, they had a very strong second half, and they are saying that even though they are not likely to hit their guidance, they are still going to be increasing production volumes by about 6%. So the combination of that, plus the Rand gold price, has resulted in a lot of cash being generated by Pan. And I think they're doing something quite interesting with it. So like they're reducing their debt load, and then they are instituting a share buyback program. So that could be beneficial to shareholders. I think it's maybe debatable whether a share buyback is the best way to return capital to shareholders. Maybe a special dividend would have been more appropriate. But it's rather that than going out and trying to buy an asset.
Yeah, I mean, we've been seeing some of these gold players looking out for some assets. I mean, was it a week or two ago where Harmony Gold announced that they are going to acquire a copper asset? All right, let's hit pause on the conversation, Richard. Before we move on to your stock pick, let's take a moment to touch on some counters that have been attracting interest from your industry peers.
I'm picking a US listed stock in the buy now, pay later sector. There's quite a few plays in the sector in the US. There's Affirm, there's Klarna, there's Afterpay, but I'm choosing Sezzle. It's a bit smaller than their competitors, but if you look at all the reviews of the users of this buy now, pay later service, they get better reviews than most others.
Okay.
If you are very good with your finances, this is a beneficial product. You can buy something and they will effectively extend you some credit, and you can pay in 4 installments with no interest, and that's brilliant. But the moment you miss an installment, oh my goodness, the fees and the interest add up. And that is the whole model of buy now, pay later. So it's very good for people who are disciplined in their finances, and it is costly for people who are not disciplined. And Sezzle is a responsible player in this industry, I would say. They announced today that they are taking Shopify to the US courts for anti-competitive behavior. So hopefully that means that they can get their plugin into the Shopify app or ecosystem to work even better. So far it hasn't really worked for them. But of all the buy now, pay later operators, I like Sezzle the most.
My stock pick of the day is Workday. It's a software as a service company. They do cloud-based human capital management, so HR, payroll, financial management, etc. They compete with SAP, Oracle, playing in that space. But it's a quality operator, strong cash generator. And I really like these software companies that are entrenched in large customer bases, because I think if they use AI properly, from cost saving point of view, from a data integration and analytics point of view, there's a genuine opportunity for growth and for operational leverage as well. So I think they are well positioned for that. And so my pick of the day is Workday.
All right, so both Grant and JP going for international counters, Cecil and Workday. Your analysis on those stocks?
Yeah, it's a tough one for me to comment on. I mean, I must admit, I'm not really trawling through the Nasdaq for investment ideas at this point in time. Look, I mean, one can't get an investment return without taking on risk. It's just you are taking on some sort of risk, no matter what the investment idea is. Now, with these sorts of businesses, the risk that you're taking on is valuation risk. So I don't know the two counters intimately, but they do seem to be growing businesses, right? But they're also very highly valued, which means that the expectation is that these businesses are going to continue to grow for a long period of time into the future. Now, coming back to what we spoke about earlier about the future being unforecastable, those growth profile of those businesses is going to change. And you don't know which direction. It could be impaired, it could be even better. You don't know. But the thing is, where there are profits, there will be further competition coming to try and eat those businesses' lunch. And in order to generate a return from such an idea, you have to be really sure that those businesses are going to be able to withstand that additional competition coming for their profitability. It's not a way of investing that sits very naturally for me, personally, just based on the fact that I don't think the future is very forecastable. You have to be really sure about the competitive advantages of these businesses such as these. Your other two guests are maybe better placed to be making those decisions or those assumptions. But for me, the expectations seem to be very high, and maybe they do exceed those expectations. But when the expectations are too high, it's most likely that they don't manage to meet those expectations. So that's all I can really say on those two ideas.
All right, then what are you sure about? What's your stock pick?
Yeah, so on the completely other end of the spectrum, I would say. So looking at a South African Inc. business, so like Netcare, the private hospital group. So all of us watching the show, I'm sure, are familiar with Netcare and its other listed competitor Life and the unlisted Mediclinic within the Remgro group. There is not a lot of positive things one can say about private healthcare in terms of an investment decision. You have got a stagnant pool of insured lives. You have got consumers under pressure and trading down. You have got healthcare funders trying to put pricing pressure and try to encourage outpatient procedures. And then you still have NHI hanging in the background. So there's very little positive sentiment around the sector. Having said that, though, both Netcare and to a lesser extent Life are still able to grow their earnings. So Netcare it's not like massive double digit at a top line level, but they are able to grow their earnings and they are able to expand their margin and they are able to generate cash. And I think they're doing something very responsible with that cash generation, where they're returning it to shareholders via dividends and share buybacks, which makes sense at their valuations. So you've got the situation where a very entrenched business, because there's little to no capital entering the sector. I think Life is building one new hospital in Paarl, and that's all that's really on the radar in terms of new beds being added. And if anything, you're probably likely to see consolidation within the industry, maybe not within the big three, but you still see some consolidation. So you've got the situation where you've got stable cash flows being allocated responsibly at a not very challenging valuation. And I think if it is a very simple to understand investment case. It's quite boring, I would say, and the sort of idea that it's not very exciting. And because of that, I think the expectations are low, which means that the likelihood that the business exceeds the expectations is a lot higher.
All right.
And I think that's going to result in a good investment outcome.
All right then, Richard, Netcare, one to look out for. Thanks so much for joining us and sharing your analysis of trade at midday. That was Richard Court from Argon Asset Management.